Ever wonder how the rich avoid taxes? Well, you're about to find out. Even wealthy folks want to keep more of their money in their pockets. And they've got some pretty cool tricks up their sleeves to do just that. From investing in the right places to giving charity, there are a ton of ways to legally reduce your tax bill. Hi there, welcome to Luxio, the place where we motivate and inspire future billionaires like you. In this video, we'll show you 15 of the most effective methods used by the rich to dodge their taxes. So grab a cup of coffee, sit back, and get ready to learn some insider tips. Number 1. Stocks over salary. There are 2 reasons for this. First, equity can grow in value over time, and second, it's not taxed unless you sell it. That's how Elon Musk got rich so fast. Can you believe it? Elon only earns between 0 to 23K per year as Tesla's CEO. Instead, he gets new minted stock based on the company's performance, which is why his net worth is soaring. Number 2. Turning cash into privacy coins. Crypto is revolutionizing the way we transfer and protect wealth. Can you believe you can carry $1 billion on a tiny device in your pocket and take it anywhere in the world? Crazy, right? With well-regulated options like Bitcoin and Ethereum, there are measures in place to make sure everything is above board and everyone is paying their fair share. Plus, profits from crypto sales are usually only taxed at 10% in most countries. So, it's a more profitable option compared to other assets when you factor in industry growth. Bitcoin is completely legal and here to stay. With the rise of blockchains, there's a new type of currency called privacy coins that allow for anonymous exchanging, storing, and transferring. They're not illegal, but it depends on each jurisdiction. Popular privacy coins include Monero, Dash, and Zcash. The idea is that if you earned your money legally, you should be able to spend it without anyone peeping in on your transactions. Number 3. Purchasing artworks. So, here's a little secret only the rich know. The art trade is the only market that isn't regulated. When you buy a piece of art, it can count as a deductible expense. Let's say you make $1 million this year and you splurge on a $1 million painting. Your expense matches your income, so there's no taxable money left. 3 years later, the same painting is worth $6 million. If you donate it to a museum or your art foundation, you just scored a $6 million tax deductible. And if you're still making $1 million a year, you just saved an extra $5 million in non-taxable income. All legally, and you can do it again and again. If you sell the painting for $6 million, you'd normally have to pay taxes on the $5 million profit. But if you use that money to buy more art, you don't have to pay any taxes on the profit. That's why the wealthy buy art, and why you won't find this information anywhere else. Number 4. Living in different countries with no permanent residence. This one's a bit sketchy and confusing, but people have actually pulled it off all over the world. Taxes? You gotta pay them in the country where you live. But what do you do if you don't have a home base? Some super rich people own properties all over the world, but don't officially call any one country home. They give an address from one of their overseas properties when asked, even if the government there doesn't really provide any extra info. Others live on their yacht and just sail from place to place. Having multiple citizenships is a smart move, but going completely off the grid probably isn't the best long-term plan. Number 5. Investing all their money. Unless they need the cash, rich people don't hoard money for a certain purpose. The golden rule for filing taxes is this: the profit that is reinvested is tax-free. If your business gains $5 million in profit, and before the fiscal year, you decide to put those $5 million back into the company in an effort to expand it further, then there are no taxes due on that money. That is how businesses expand fast. Your net wealth as the company's owner soars, and you owe little to no tax on the increase. Number 6. No cash, but you got assets to borrow against. Majority of rich people are extremely wealthy, but don't have cash because they never withdraw money from their businesses. Because if they do, then they need to pay taxes. So instead, they leave their money alone as assets or stocks. But there are times when you'll need some cash. That's why a relationship with your bank is important in this situation. Rich people enter banks and boast about how many vehicles, assets, and stocks they have. They'd say, "Give me a loan if the need arises. I'm willing to pay." Banks evaluate the portfolio before granting rich people cash. Number 7. Making their boat a residence. What's noteworthy about taxes is that they favor homeowners and hate show-offs who are really rich. Ever wonder why the hashtag tax the rich is currently trending on social media? What then do wealthy individuals do to fight this? To receive lower tax rates, they declare their boats to be second residences. In the end, it's true that they use it as a vacation house when they visit Mykonos in the summer. The IRS considers a boat to be a second residence if it provides sleeping, cooking, and bathroom facilities. The same applies to motorhomes. Number 8. Everything you use is a company property. Here's another tax tip. Subtract everything. The money you spend is not taxed if it is needed for a business to operate. You want to get a brand new vehicle for yourself? The vehicle is also needed by the business. If you need it to run the business, then let the company purchase it on the company's money. Some of the items that wealthy people subtract are laptops, phones, and gadgets. Well, they're all necessary for the business. Travel is another necessity, including lodging and transportation. Home office, utilities including the internet, and health insurance premiums are also needed. Even eating out is a deductible cost. The more expenses you can write off, the less money there is to be taxed. Number 9. Declaring bankruptcy. Except if you're really wealthy and know how to handle it, filing for bankruptcy is expensive, time-consuming, and difficult. Here's the process. Say you earn $250,000 a year and you saved an additional $1 million in addition to owning a $1 million house. You want to start a business, so you choose to invest $10 million in an office building. You visit a bank, put down $1 million, and then purchase the office building with a $9 million loan. A pandemic strikes a year later, and all of your renters depart. You still owe $9 million to the bank. Even worse, nobody wants to buy an office building. So the structure you now own is only worth $5 million. Now, the office building is held by a firm. Your attorney may declare bankruptcy, but bankruptcy regulations prevent the bank from taking away the property or siphoning off your salary, even though they will take the office building away from you. And you will have a tremendously difficult time ever working with the bank again. The distinction between being poor and being bankrupt is this. Rich people can be bankrupt, which means that while their net worth may appear to be zero or even negative, they will never be in poverty. Additionally, even if you paid for everything in cash and didn't need the bank, the financial loss would still qualify as a tax deduction. So what happens is that you won't have to pay taxes on your income for many years until you make up for the money you lost. Number 10. Utilizing a trust to evade inheritance taxes. A popular adage among the wealthy is that one doesn't realize how much they have to be grateful for until they have to pay taxes on it. Unless you're wealthy, you may not be aware of this fact. If you pass away rich and wish to leave money to your children, the state may impose a tax of up to 45%. Of course, there's a tax on estates. If your net worth exceeds $11.7 million, you are considered wealthy in the US. There is either no estate tax or a very little estate tax for somebody worth less than that. Although $11.7 million might seem like a lot of money to the normal person, we live in a world of billionaires. And our first trillionaire is probably going to be born in this generation. The current rate of inflation will soon make everyone a billionaire. Rich people are utilizing trusts to structure their money in a way that prevents the government from taking it away from them through taxes. It's not yours to pass items onto your children if you place them in a trust, since they no longer belong to you after certain requirements are satisfied. Once the property is kept in trust, it no longer belongs to anybody and is not subject to inheritance tax. Additionally, it prevents you from giving your child possession of your whole estate while you are still alive, because they might simply blow through it if they so choose to. You may also create rules akin to smart contracts so that your children gradually have access to the trust's assets whenever they meet certain criteria, like graduating from college or turning 25. Number 11. Moving to a place with low or no taxes. People frequently underestimate how drastically their lives would change if they move to a place where they're allowed to keep their money. In some places like Dubai, Monaco, the Cayman Islands, or the Bahamas, there's no income tax. You're not required to pay taxes on the money you earn. But here's the catch. Moving there is typically quite expensive, which explains why the wealthy have an advantage. Even with this, Monaco's cost of living is quite expensive. Number 12. Reducing assets' book value to exceed their cash income. If you want to be wealthy, you should learn how to speak or at least comprehend accounting, because it's the language of money. A firm can write off the cost of an investment it makes, like a car, machine, or other item through depreciation. For the duration of the investment, it's dispersed. Spreading out property cost deductions enables a firm to be in a position to replace the asset when it reached the end of its useful life. Now, suppose you spend $10 million to purchase a factory with the intention of using it to produce those unsightly face shields for the next 10 years. Number 13. Moving your business abroad. Facebook, Google, and Apple all operate in this manner. Because of Ireland's welcoming tax policies, they founded businesses there. These businesses are intellectual property owners. Each year, the US firm must pay a license fee to the Irish corporation to continue creating and marketing items in the US. For the US business, this gives them a legitimate deduction expenditure. Through this technique, they're transferring money out of the US economy and relocating it to Ireland, where they end up paying only 1% or possibly less. If you live in a nation with low income tax rates, you can always make a local business there and bill your US subsidiary for services done. Hence, you can reduce the tax burden in the US. You see, tech giants would rather pay a penalty than their full tax dues. Number 14. Giving money as a gift. Did you know you can give things to people and not get taxed for it? Here's the catch though. The gift can't be worth more than $15,000. If it's worth less, no worries. You don't have to tell the IRS about it. $15,000 is barely enough to get a Rolex watch. $15,000 doesn't seem like a lot, but don't worry. There's a lifetime gift exemption cap of $11.7 million in the US. As long as each gift is less than $15,000, you're good. If you're clever enough, $11.7 million in tax-free wealth means a ton of Rolex watches. Number 15. Donating or making a charity. Did you know that donations to charities are not tax-deductible? It's true. This is why rich people have some sort of charity or foundation. In their defense, the state has a history of being a bad manager of funds. So, they're better off having a foundation to make sure that the money they donate actually goes to good causes. It gets intriguing when you realize that even these non-taxable foundations have deductible costs. Think about how companies need equipment to operate. Even giving properties, cars, or other assets to a non-profit you own still qualifies as charitable giving. Then, you can still use these assets as the charity's director. And there you have it. We hope you learned a lot from this video. Don't forget to like, share, and subscribe. Hit that notification bell so you're always updated with our latest videos. See you later!